Welcome to Shareholders of a Better World, brought to you by TBLI Group. At TBLI Group, we have an established reputation as an organization dedicated to building the ecosystem of global sustainability and impact investing. We're doing this through educating, advising, and facilitating transactions in global sustainability and impact business, as well as capital solutions for private companies, family offices, and fund groups. For nearly 25 years, TBLI Group has created a vertically integrated ecosystem of education to action through TBLI conferences and TBLI consulting. More about our company can be found at tbligroup.com. This webinar is brought to you by TBLI Foundation, which hosts educational learning experiences dedicated to a better planet. Through the foundation, we build sustainable communities by sharing the people and the experiences making a difference to so many of our lives around the world. Our weekly podcasts bring impact thought leaders that are doing and not only chatting. Now let me introduce my guest today. Good afternoon from our studio in Amsterdam, actually one of the other rooms. Thank you all for coming. Before I introduce our special guest, Matt Moscardi, for those of you who haven't joined our system before, if you have a comment or question, type it in the lower right or left-hand corner where it says comments or questions. If you want to clap or you find something brilliant or funny, there are 3 emojis that you can use. And if you need to send a private message to anyone in the chat area, just move your mouse over their name and a window will pop up and you can send them a private message. There's also a chat area for sending messages to the group chat. We'll do a small mixer at the end if there's enough people still around. So our guest today, Matt, if you can join us now, that'd be great, is Matt Moscardi, who has a brilliant career in ESG at MSCI and wanted to make it an even better system. And he created all kinds of initiatives, particularly one of my favorite radio or podcast shows. So Matt, for those of the audience that are not familiar with sabermetrics and FreeFloat and what you do and your criminal record, if you can just briefly share what got you from big shot at MSCI to an even bigger shot at FreeFloat.
I don't know about big shot or bigger shot. I was at MSCI for almost 10 years. I was on the ground floor. I actually started by creating the financial sector ESG ratings. So I know the guts of the MSCI model and all the ESG models that are out there. And after 10 years of being there, I steadily moved my way through MSCI, but I was tired of being told no to building new things, trying new things. So my co-founder and I, Damien, left MSCI and we started a podcast, Business Pants. And mostly what we wanted to do was talk about the business news like we did around the water cooler. I mean, the virtual water cooler, but the water cooler, where we'd make our, snarky jokes. We'd look at data. We'd do fun analysis of oh, I wonder what color pants all the CEOs like to wear most. I mean, we'd do our ridiculous stuff, but it was all grounded in fact and data. And at one point we covered Boeing and the MAX 8 planes. And we did a deep dive into the board that greenlit the MAX 8 planes. And what we found was that 2/3 of them were connected through one director, the head of the nominating committee, who had a lobbying firm. He was an ex-Reagan official. He had a lobbying firm and they were all his clients. And it got us on this path of who is on these boards? How do we understand them? Who is, picking these people? What are their incentives? Who's the most powerful? Who's the alpha in the room? Who does everyone listen to? And we built it. We basically took the last 2 years at FreeFloat to build a way to measure the power influence of every board member in any given year at any given company. And then using that, we can attribute performance. So now we have power and influence for individual directors over, I think we have 7 years at this point of data, and their performance attribution, which includes things like carbon. We can tell you who the most carbon efficient director is, which ones are the best at labor, which ones are the best at, if you are a traditional shareholder and you like share buybacks, which ones are the most, have overseen the most share buybacks, any number of metrics that you want to ascribe to the management or oversight of a company, we found a way to do it. So that, in a nutshell, and I was a musician first. I fell into all this. So like that's my nonlinear path to what we do now.
At the moment, because you said that you kind of run it like a football sports radio show, and that translated into almost like baseball cards or football cards in rating directors. So how are you actually getting the data about directors? Because there seems to be a general, look, we should look at corporate governance, but people don't, a lot of the ESG measures don't look specifically about the directors, which is what you do. How are you getting that information, and how are you kind of ranking them?
So the funny part is that they have that data. Well, our data comes from S&P and MSCI and Preqin, which is a private market data provider, S-Gage, which is another ESG provider. It's actually all ESG providers that we get a lot of our data from. We've scraped or captured our own data too. Probably 35% of the data we have is our own. But the fact is, they have the data. And this gets to sort of the entrenchment in the ESG community, right? We wanted to put people back in capital markets. There's a constant conversation about like, how are we going to stop climate change and what companies need to disclose, and they need to stop emitting. But the fact is, it's people who make the decision to stop emitting or to make a capital allocation decision to change the direction of a company. It isn't some amorphous company. So we wanted to sort of unwind at least a bit of the Limited Liability Act from the UK in like the 1890s or 80s, right? And by putting people back in, you hold them accountable. They have all that data. The problem is it's the third rail for them. I mean, imagine telling a person who is at the peak of their career, in as much as they have a job that pays them $300,000 a year to show up to 10 meetings, and that's it, right? They can often sometimes direct strategy, but a lot of times that's the pinnacle of your career. But we're telling them, guess what? There's a bell curve, and a lot of you are average at your job, and a lot of you suck at your job, right? And we can see it in numbers. That's really hard, and the ratings providers don't want to do it, so they don't. ISS has every scrap of data that we have. They have it. Glass Lewis has it. MSCI has it. They all have it. Just no one wants to do it because they're afraid of the repercussions of doing so. So we don't care. We're a 4-person startup. We managed to scrape and scrap our way to 250,000 directors and executives and 80,000 current directors and executive, or I think it's 100,000 current, and 7 years of data and 10,000 companies. And it's all on our platform, and we put it out. So it's not, and to the sports question, right? The reason why we chose the sports analogy is sports analytics are actually highly evolved relative to the way capital markets view people. We know tremendous amount about every soccer player, every hockey player, baseball player, basketball. You can tell how many minutes they're on the floor, how much they score per minute, what their contribution to a team win is, how defensively oriented they are or offensively oriented they are. And yet you can't probably name 10 directors off the top of your head at companies that we own. And they're the ones we elect to steward our capital. And we're talking about trillions of dollars in capital, and we know nothing about them. So our use of the sports and sports analytics is on purpose, because when you measure the impact of like how an individual acts in a team, sports is more advanced than capital markets are. We're applying the same methodologies. And in fact, when we talk in the language of sports analytics, people tend to actually understand it a bit better. Like, your board is a team. You elected the team. Who's playing what position on the team? How do they think about, making decisions? Who is the team leader? Who's the captain? Is the captain the one you elected to be captain, or is it actually someone else who's not the elected captain but runs the show? We can tell a lot of that in the data. And there's academic papers that we built it off of. So we use sports as like an on-ramp to understand the approach and some of the analytics. But for the most part, we're touching the third rail and doing it in a way that's like we make it accessible, or we try to, for people who wouldn't otherwise understand it.
But the like you're collecting all this data, which all of the other data providers have, but they're not actually using it or offering it. Do you find that investors actually want more specific information about the board members?
We find actually there's two camps. There are investors who immediately understand the implications of knowing more about their board members and want to use it immediately. That actually tends to be stewardship teams who aren't that steeped in ESG. The way they use ESG right now, about 90% of an investor's vote for any proxy vote is directors on average, right? So when you get a proxy card, you're mostly just voting on directors. ESG has been used for about the 10% that's not the proxy vote. It's been used for, should we, separate CEO chair? Should we issue a report on carbon? The little margin things almost to the companies themselves. Their stewardship teams recognize immediately this is a way for us to understand the vote better than we ever have. The irony is most of the ESG investors that we've talked to think that when they see something like, we found that the directors at Microsoft is usually a top-rated company for ESG, especially around issues of carbon, because they've made a net negative, target, and they've made a lot of noise about it. And we found that every director on the Microsoft board in their careers have never seen carbon go down. Not just on Microsoft, but across any company they've ever been on. Carbon's never gone down on their tenure. And we have ESG investors who actually argue with us, like, your data can't be right, or we don't agree with the methodology. That doesn't make any sense. This is a top-rated company. We've always thought it was a top-rated company. They say the top-rated things, right? So there's two camps. There's sort of like a weird entrenched ESG community that pushes back on what we're doing. And there is a stewardship community that has often pushed back on ESG that loves what we're doing. So I don't know what to make of it. But I do know that, like, for a lot of people, they recognize it's new and it's weird and it's going to take time to figure out how to use it. But it is something. And it is, I actually talked yesterday to a professor, Sidney Finkelstein, he's at Dartmouth now, but in 1992 he wrote a paper about power on management teams, and our data basically coalesces with his, and his response was, finally someone did it. It's been 20 years and someone built it. I can't believe someone actually built it. So I know that there are people that recognize the potential really quickly, and then there are people that push back, which is great. That means we're doing something right. We're pissing someone off.
But if there's, you're the poster child now for Kevin McCarthy and the woke or the anti-woke community.
Yeah.
But when you're doing these ratings, do you see any correlation between companies that have significant improvement or very good, consistent ratings around ESG and share performance?
So we're doing studies like that. I mean, part of me wants to avoid them, and I want to avoid those studies on purpose, because once I go down the path of, the question of, prove to me this has alpha, right? Then are we asking the right question? Are we asking, do we want change or do you want alpha? Because I can provide you alpha without looking at directors. I can provide you alpha in any number of ways. And in fact, alpha is so intangible. At MSCI, we would deconstruct the returns of a company to across 20 plus factors, right? Like little infinitesimal, like 0.2% of the return was from a country, foreign exchange. It was so infinitesimally small that they can deconstruct like what is stock specific return and what is alpha at a level that's a little ridiculous. For me, I'm asking the question of who do you want to represent you, right? Forget you want alpha from your investment. You want return from your investment. But who do you think is best positioned to guide you for that return? Going backwards, we have no comps. It's mostly cisgendered white men who run companies. So if you were to tell me, like I got asked, well, show me that adding diversity to your company will increase my returns. Otherwise, what are we talking about? Diversity. And I said, well, show me that having all white men has increased your returns. You can't. You can't prove the negative, right? So for us, we actually there are grad students who are looking at that question of returns, and we're going to let them look at it. But we're not actively sort of chasing it yet. We're actively in a place where we want to say, what is the real life social dynamic in that room? How can we measure who's making decisions, where they came from, where they derive their power from, and then look at how the companies have performed after those decisions have happened, right? Beyond that, we can tell you like which directors have the, longest track record of positive TSR, but we don't want to be in a position to say like, oh, here's your super team. Here's your 10 directors that you should put on this board because that would be a super team. We don't know what that looks like now. I mean, if I'm honest, I shouldn't say that because then people are like, why would I buy it? But in a way, that's the honest answer. And if anybody tells you that ESG ratings like generate alpha, they don't by themselves. It's you who make a decision to use that rating in a way that might generate the alpha. The ratings themselves don't do that. Just like no data point does that, right? Like it's thinking human beings. It's not even AI who does it yet. It's still thinking human beings.
Who is mostly interested in this analysis of board or directors' performance or behavior or actions or how they engage on climate? Who is most, if you have to make a kind of hierarchy of people, is it mostly endowments and activists, engagement, church people, or is it more family offices or both?
I mean, we have the Gates Foundation uses it, for instance, but we have Morgan Stanley who's used it, and we've had individual portfolio teams. One of the things we get asked to do, rather than just providing them data, is to come in and we got asked to lob grenades at a portfolio, and that was the request. And so we go in and we look at every director and the structures, and we say like, well, here's this is absurd. Here's what you invest. Here's who you invested in, not what you invested in. And we give them that information. So it's endowments, sure, and foundations, but it's institutional investors, and we've made it available to retail. Because now you have pass-through voting in the U.S., where Vanguard and State Street and BlackRock are allowing greater levels of pass-through voting. And for us, that means, forget normal traditional financial data. The retail investors don't have anything generally. And we think that a great place to start if you're a retail investor is who you invested in, not what you invested in. And for us, that means we made the S&P 500 on our platform is free right now. I mean, you can go to freefloat.llc, click on the little, login button in the top right, sign up with an email address, and you get S&P 500 directors for free. And that to us is, the goal, to serve a little bit of everybody just to make these people known. But our primary buyers are, they are institutional investors, whether they're foundations, activists, or, traditional.
Can you, your focus is mainly the public markets, listed equity. Do you anticipate a period where you might be able to use this for maybe later stage private equity?
Absolutely. And we have talked to, the listing the listing brokers of the world about what our data suggests, right? And one of the reasons why we work with Preqin, who has some people data. Now, data in the private markets is hideously terrible. So, and the people data can be outdated or can be just flat out wrong. So one of the things that we've tried to do is get into not just private companies and asset manager people data, but into nonprofits. A lot of the sort of horse trade of humans happens in the nonprofit world. So we're getting into private markets and late stage private, that transition, getting in to get listed, like what you need, what your team should look like, that kind of stuff. We've had interest from people. The data has been hard, way harder than in the public markets. I mean, we've scraped together as much as we have in public markets because it's easier to scrape, and we're working through the privates, but it's not great.
Do you find that there is a distinction? Obviously, there's far more men in boards of directors than women, so it's a little bit hard. But do you find that they're better stewards, women-led companies, or where there are a larger percentage of women in the board in the performance ratings that you see or that you find?
So I can tell you this. I don't know about better, but I know about power. So there's been concerted efforts, particularly in ESG communities, to increase diversity on boards. This we know, right? It usually means setting a target of the percentage of women on a board or the percentage of people of color on a board in the United States or in Europe in particular. What we see when we look at the influence or power dynamics inside the boardroom, to the extent we can measure it, but that's what we try to do. What we see is in places where every place, this is uniform, everywhere that has higher percentage of women on board, the women almost universally have less power. The way the dynamics end up working is, we have diversity, but not inclusion. That's what we've managed to achieve. We've managed to achieve some level of diversity and virtually no inclusion. And that includes in the Nordics, in Scandinavian countries, where you have very high, mandates, 40% women on board in Norway, for instance. Norway is the worst performer for power that women have on the boards. So you may have a mandate that says 40% women, and every company can comply with that. But what we're seeing is they don't get committee assignments. They have smaller equity, shares. They have, everything about sort of the system in place results in less influence or power over decision making. And we call it the gender power gap. So we can actually rank companies based on the gender power gap. So we can see the companies where, it's flipped, where there are fewer women who have more power, or there's, and then the negative, where there's a lot of women who have very little power. The rule of three seems to be a useful rule for achieving diversity, but not necessarily a useful rule for achieving inclusion. To that end, we don't really know, are women better stewards, because there's so few companies globally where women actually have more than 50% of the influence or power over decisions.
Wow. Can you say who is your superhero board? I mean, if all of the boards were like this, man, we'd get this mess cleaned up in a jiff.
Not really. What I can say is I have favorite directors.
Okay,
I mean,
that's good.
And by favorite, I usually mean it in that tongue-in-cheek sort of snarky way, because there's a director named Ron Sugar. So one of the things that we do is we tag directors based on like attributes that they have, whether or not they're sit on a lot of very controversial companies, or whether they're highly interconnected to all the boards that they sit on, or whether or not they're like, power brokers, meaning we can do social network analysis. The same, you go on LinkedIn and it says, so-and-so, you might also know this person, right? There are central cogs in those wheels of social networks. Somebody who has 400,000 connections, that's where LinkedIn's saying, well, you connected them and they're connected to them. So that's how you might know each other. you can measure that on boards and board interlocks and some of their affiliations. So we can say like, okay, well, who's the central cog? We'll tag people and we'll call them scandalous. We'll call them connected. We'll call them influencers, power brokers, environmentally friendly or investor friendly. We have all sorts of tags for them. Ron Sugar is on currently, like right now, he's on 4 boards, but traditionally he's on 4 to 7 boards. He's constantly recycled. They're all the largest boards, like they're all large cap or mega cap companies. He's on the board right now of Amgen, Apple, Chevron, and Uber. He's on that board. On those boards, he has anywhere from 6 to 16% of the influence. But he has this long career of being a massive power broker. He is, without a doubt, between him and his friends of friends, because we map them all. We can say his sort of network power is in the trillions of dollars, right? Like, as in, he has influence over some X billions of dollars if you take his influence times the market cap. But then his friends have that influence, and his friends of friends have that influence. When you add it all up, he is without a doubt. We name him on our show all the time. Well, actually, in our Slack, we have an emoji for Ron Sugar. We have a sugar emoji. Nobody knows who this guy is. I mean, maybe some people, but that's where we live. We live in that place of like, I can't tell you necessarily. I have opinions about like who, amazing boards might be, but I can't say for certain, like the data says they're an amazing board. It's really just, I like that board because of the way they're constructed. But what we do have is sort of like icon directors, like Ron Sugar, where it's like, this is exactly how boards we think get constructed. It's that guy going around. Everyone knows him. He knows everyone. He's on all the boards, and he just goes from board to board. I mean, he was on Air Lease Corporation. He's been on, he's been on so many boards and so many places. There are people like that. Bob Eckert's one of them, and we have it, globally. We have, German boards and UK boards and Japanese boards, and there's people like that everywhere.
Is there any? I thought there was a new regulation in the Netherlands where they would limit the number of boards that a person can be represented. Is that the same in the U.S., or is it like you can go on 50 boards if you wanted to?
It's only the investors in the U.S. They tend to vote you out once you hit the 4 or 5 board limit, or tend to vote more against you, but there's no regulation against it. And most of those regulations limiting the number of boards you can be on, it's not that they're bad, because you can't really concentrate on more than a couple things, right? Like, so it would be really hard to be on more than 2 or 3 boards, I think, just as a human, right? But that said, it has nothing to do with power, right? Like which boards you're on, how much power you have on those boards. Those are the things that matter to us. There are a lot of people who are on like 5 boards, and this is particularly true of people of color and women. They are overboarded. We call them recycled directors. You've broken into the glass ceiling, or the brown ceiling, to be really crass about it, right? You've broken through. You're on a board, and then all of a sudden, you're on every board. Anytime anyone needs a person of color, you're getting a phone call. Anytime anyone needs a woman in tech, you get the phone call. Ann Mather's one of our favorite recycled directors. She's been on like every tech board. And I mean every single one. Every major tech company, basically, she's done a stint at, which is great for her. But it also means that there is no effort to add new people to boards. They're recycling directors that way. And we can see that in the data, and there's no limitations on that. And on every board she goes on, if she has 3% of the influence, what are we really doing? Aren't we maintaining the status quo by adding diversity but not inclusion, right? So there is no rule in the US. There's no mandate. But even the mandates sometimes feel moderately, not misplaced. They feel like there's room for improvement, because what we really want is diversity of thought and inclusion of those thoughts, and not just adding people to the board.
Do you think that, because I know one particular woman who's desperate to get on a big listed company. She does everything to try to get in, but she's never got on there, and she fits all the boxes that you're talking about. How do you get on a board to begin with in, let's say, Europe or US?
I mean, the traditional way to get on a board is who you know. It's why we started on Boeing with the first question we wanted to know was who everyone knew, like where they all came from and who they knew, and it's fairly, I gave a talk at Chief, I gave a talk at the fourth floor. These are organizations in the U.S. that are dedicated to putting more women on boards, and they do like all sorts of classes and instruction, and they say like, but look, we'll get you prepared to for if you get a call to be on the board, but the reality is the way to get on a board is usually through networking on the golf course. That's usually it. And a question came through, and I know I'm like, but I'm going to speak to the question by
No, sure.
answering,
Go ahead.
at the same time, asking like, is board selection just pro forma at that point? In a way, yes. That doesn't mean that board power isn't a real thing. It means that the way boards are selected are to maintain that power, right? The interesting part is when you add someone to a board and you give them power, and the dynamics of the board shift as a result. The interesting thing that we see is when board dynamics change over time. And a great example of this would be like Disney, right? Disney, Bob Iger was the white knight. We call him Ken Doll Bob because he was like beautiful and on chair of the board and CEO of Disney, and then he gets replaced by Bob Chapek. Well, he steps down, right? And what we saw in our data was Bob Iger goes from having like 40% of the influence of the Disney board. He was basically the big man on campus, and I don't think anyone would really disagree with that in reality. He left, he becomes executive chair, and then he steps down as executive chair. But when he left, Bob Chapek did not step up as the most influential person on the board, even though he's the CEO and on the board. Susan Arnold was the chair of the board. She, our data, was the most influential person on the board. Not by much, but she was. When we add in executives, the second most influential person at Disney management was Christine McCarthy, the CFO, who just stepped down for family reasons. But Arnold and McCarthy are the two who got Chapek ousted and brought back Iger. The interesting part about the data that we have is that, yes, board power tends to maintain a status quo, and that's what we're trying to disrupt. And measuring it means that you can see when it gets disrupted, whether by accident or not. So I guess the answer to the question here is adding women, adding people does not necessarily, like do what we want it to do, and the mandates don't do what we want it to do. But we want to. I mean, like the data you can see in the data when boards get disrupted, how they get disrupted, and what when the social dynamic changes. That's what we're trying to do.
And how bad does it have to get? When I look at Clarence Thomas with all of these horror stories coming out, the guy's still there. Nobody's pushing him out. So how horrible does it have to get for a board director before he's pushed out, or he or she is pushed out?
Well, that's part of the funny part. I mean, it has to get pretty horrible, but usually they won't. It depends on the structure, right? Like you can't push anyone out on Zuckerberg's boards, right? Like you can't push anyone out of Meta because he has all the voting power. So in that case, they could do whatever they want. That's horrible. Mark can still just say, I don't care. I'm leaving my board together. So there's structural considerations, but companies have gotten savvy. So one of the things that we see them doing is increasingly putting women as the chair of the nominating committee, for instance. And when they do that, they do it so that you can't vote out the chair of the nominating committee, because if you've only got like 2 women on your board and one is the chair of the nominating committee and the board never puts up another woman, right? Like they just say, oh, we have some diversity on the board. You've effectively insulated the role, and investors are they're reticent to vote her out, right? Even if they don't like what's happening for board selection. It has to get pretty horrible, though. I mean, the power structure exists in the way it exists for a reason. It maintains itself. And one of the things we've heard even from the stewardship teams is, while this is data they've never seen before, they told us it's really aggressive to vote against a director. And To which I responded, isn't that the job, right? Like your job is to measure the people who are the stewards of your capital and vote them in or out, right? Aggressive just seems to be part of the job. Like you're supposed to do that. But they want access to management. And they're worried that by voting somebody out, taking a stance, taking a hard line, they are going to piss off management and have less access. So really horrible, sure. But it's really a calculation between when is it so painfully obvious that I need to get rid of a person versus I can tolerate this person because I get something out of it, like access to management in a way that I like, or, it isn't a contentious relationship within a company I've invested in, that kind of thing.
But isn't that the issue with a lot of journalists who are happy to kind of put up with a lot of the bullshit just to be able to go on the junket, the private plane, the meeting, the press conference at the White House, and don't want to piss them off. That's also their job. But you see more and more, fewer and fewer people willing to speak the radical truth and say, I'm sorry, but your children are ugly. Doesn't that seem to be a sign of the times?
I mean, yes. And look, that is, but if you think about, yes, the short answer is yes. That's what it is. But the longer answer is that what we want? Right? Like, is access so valuable to us to one particular elite class of human being? Is that such a valuable thing to us that we are willing to compromise with what we say about those people? The answer to date has been yes. The way we're approaching this is if you use data, it gives you a way in. In fact, when we consult with a lot of these stewardship teams, we can say, I know you like that person, right? But we are not measuring the person. We're not saying they're nice or not. We're not saying like, what we're saying is the data suggests they underperform. Now you have a reason to vote a different way. Now you have something to talk to them about, right? Like, what are we doing about our earnings? Like, I'm noticing that, the company's earnings have been great, but over your tenure, earnings haven't been fantastic. Or how are you thinking about that? Have that conversation now. And if you're not willing to, our Trojan horse is we make it public. Like the data is free, right? For the S&P 500. And that it's free for a reason, because I want a journalist to say, investors have voted yes on this director, despite the fact that they are low influence and one of the worst performers on this board. Like, and then go get quotes from the investors. Why did you vote for that person? Right? Like the data suggests, that they're really bad. Sunlight is a great disinfectant. And once you normalize the idea that you can vote against a director, which ironically Strive and the anti-woke, Vivek Ramaswamy and the anti-woke movement, they're cool with this. They love voting against directors. It's like their favorite thing. They usually vote against women and people of color, but it's their favorite thing to do. It's great. Once you get over the hump of that, access no longer has the same cachet because we can see performance that's more empirical or more objective. Maybe we can make change. But for now, the trade is, still, you still have social credit with that access.
Do you find a big difference? Because there used to be lots of complaints about Asian corporate governance. Do you find a big difference between Asian boards, European boards, North American boards, or North American, Latin American boards?
There are, ironically, actually, one of the things that we find is there are a lot of nuance and a lot of differences between them. The interconnections are the big. Gender and interconnections are the big two. In emerging markets, who actually matters more than, and this is also striated by cap. So the larger cap companies tend to be, in this country tend to be like one class that largely knows each other. Small cap companies are like, used car salesmen and the CEO of the company. That's pretty much what it is, locals. But when you get international, you have like chaebols in Korea, for instance. We can see how they all sit on each other's boards, and it's just one. You're basically buying uni companies. You're buying one set of humans and 12 different companies through the chaebols and the cross shareholdings, but it's really the cross boards that are interesting to us. The same is true in a lot of Asia. The same is true in a little bit true in Italy, and is true in South America. The connections and the lack of sort of gender diversity, or the tokenism of gender diversity, are the two things that we notice in a lot of like other countries. But one of the fun things about what we do is we can generalize at the country level, but every single company is different. They all have their nuances, like the people they put on, where they came from, how they got there, what their network was. Every single one's a little bit different and a little bit nuanced. So there are some broad generalizations, but we still find like quirks at these companies. Like, why is that person so influential? Then we have to like dive into our own data and be like, did we screw this up? What is this? And when we find like something in there that's like, oh, that's why, they know so-and-so who knows so-and-so. And they went to the same school together in 1973 and that they're best buddies. Like, we find the little things, right? Like, those are the little things we find.
You said that you were offering the S&P 500 freely accessible on your website, so you're in kind of an activist ESG measurement organization. What often happens, I'm not saying it will happen here, is that if the information or new invention is damaging, we buy this and shut it down. And that happened in the cement industry a lot. There was a Frenchman who developed cement that had very little CO2 emissions. Cement industry would buy the patent, but never develop it. Are you concerned about that for you?
I mean, we have control over that, right? Like, if I want to sell out this company, then that's like the control we have. I'm actually, it's less likely that we get bought out anytime soon. It's more likely that we get sued. It's more likely that some director gets pissed off about what they see in public and they sue us and they say, take it down. And then we have to replace so the way the platform works and looks is it looks like baseball card. It looks like cards, like sports cards. So it's like a picture and like a little card and whatever. And we have to take down their picture and we got to put up, this director sued us and does not want you to see this as their picture, right? That's more likely than getting bought out anytime soon. I think that like our goal is to disrupt some stuff. I don't like the word disruption. We're not tech people. Like I said, I was a musician, but our goal, these are the things that we dreamed of when we were at MSCI. And Damien, my co-founder, was at Corporate Library. He worked with Bob Monks and Nell Minow back in the day. They always talked about like a director rating or understanding like the human beings. We feel like if we do this right, that there isn't a way to shut it down. You can't put the toothpaste back in the tube. So even if someone were to come in and offer to buy us out or sue us, the chances that this concept goes away, I feel like are low now. Well, not yet, because no one knows who we are, but soon they'll be low.
I'm going to take a couple of questions. Aaron wanted to know, does there need to be some groundbreaking work in both the fields of accounting and economics to actually price positive externalities tied to the bottom line and 3 financial statement? It seems that without the incentive to benefit from sustainability, ESG is doomed to remain a market and window dressing feature.
I mean, look, it depends on what you want, right? Like, if you go and do groundbreaking work in like accounting and economics, you're using the rubric of accounting and economics to basically achieve, like you are doing like a valuation using ESG data. That's been tried. It's been done. There's some that's good. There's some that's shit, right? Like, sometimes the results are great. Sometimes the results aren't. if we're looking for a groundbreaking study that says this will achieve, we should price this in and in this way, we are using the construct of capital markets to do something that may not actually work very well in the construct of capital markets. One of the things that I learned at 10 years at MSCI is when it was IVA, when it was Innovest who created the original sort of financial materiality ratings for ESG. They were the sort of genesis of that concept. They adopted the AAA to triple C, that looks like a credit rating. They adopted that on purpose. They wanted to basically trick the minds of traditional finance into thinking this is a rating I understand, despite the fact that it was data that they didn't. By doing that, 2 years ago, there's an expose about Henry Fernandez and MSCI and how they've pulled the wool over our eyes because they're doing this to make more money, and it's about making money in markets, not about saving the planet. Using the language of accounting and economics often takes the eye off of what you might be trying to achieve. And if I assume we're trying to achieve some sort of positive impact on Earth, the markets aren't often the best place to sort of have that conversation unless you disrupt the markets. So I guess the short answer is I'm not sure that like groundbreaking work in economics gets you to a place that's where you want to go. Simultaneously, I'm not sure that what we think of as traditional financial metrics isn't just marketing and window dressing. Earnings management is a thing. Like managers every quarter choose what they're going to put in their quarterly statements, and they do it very, very in a calculated manner so that they can keep earnings level, so that they want to show a drop this quarter that'll go up next quarter. They do that all the time. And there's been studies about how the accounting industry and how the auditors actually have black boxes to determine what's material for traditional financial metrics. After the financial crisis, 25% of U.S. companies restated their financials. 25%, 1 in 4 restated their financials. Isn't that just window dressing? Isn't market cap often just a window dressing? Because if market cap is, or PE ratios are supposed to be investors' expectations of future returns, right? If you got a PE of 40, you're just saying that this is a high growth company. We really think it's going to, explode, is essentially what your takeaway is supposed to be. But that's just marketing. That's just window dressing. We have no idea. And it's based off of what the company's told us. I feel like the conversation needs to shift outside of, what constructs that we have. It's why we pivoted to people. It's why we pivoted off of like, what is the company doing? What's on the company's balance sheet? And we pivoted to who is the company? Because, and our dream is to map influence down to the mailroom clerk. Like, I want to know that, Gus in the basement has 0.0001% of the influence of this company. I want to know that because I want to know, I want to think of the company as a pile of human beings. And to me, that becomes disruptive because now no longer can a company say people are our greatest asset and pay them the minimum amount that they possibly can and take away all their benefits. Now they have to say, they have to account for them. In fact, the biggest missing data point globally is how much employees are paid in aggregate. You can get that for financials, you can get that for pharma and tech sometimes, but you cannot get that for any other company. And in other jurisdictions, you sometimes can't get it at all, which is psychotic. All a company is a pile of humans. That's psychotic. How much do we pay these people?
A couple of other questions. John from Climate Media wanted to know, is there any part of ESG that exists today that is useful?
Well, so yes, there's actually a lot. And ESG is, just so I'm not confusing terms. There's ESG ratings. Some of those are useful. Some of them aren't. That really depends on what you're trying to do. But then there's ESG, which is data, right? It's a data set. The data is tremendously useful. if we went back 20 years, we know 1/1000th of what we know now about how companies do what they do or what they do. ESG has been the search for transparency. So if there's anything useful about ESG, it's that. It is increased transparency. Even if 20% of the data was fraud, let's just say 1 in 5 companies is pure fraud. You know more about them, because I could argue that, 1 in 5 earnings statements could be fraud, right? Like Enron taught us that even the biggest companies on earth could be Ponzi schemes. Like, we have no idea sometimes, even if it was some level of fraud in there or greenwashing or whatever. There's more transparency and there's more emphasis on getting something, new data points out of the company than ever before. If ESG has been useful for nothing else, it's been useful for that.
Mark wanted to know, do you rank consumer influence within a company, or do you look at that at all?
So one of the things that we built at MSCI but never saw the light of day, and this is one of the reasons why I left, we built a stakeholder model instead of a market model, right? We wanted to say, well, what happens if you take these issues, you ascribe them to stakeholders, and then you say, like, how badly is this going to hurt a particular stakeholder? And I think it gets to the question of consumer influence, right? Because the consumer is one of the biggest. Your stakeholders are your customers, your investors, your employees, did I say investors? I think it did. Society and like the planet. Like, you could say suppliers, you could say some other things, but for the most part, there are only a few stakeholders, and every company has them in common. Every single one. For us, we're not thinking about it yet. We're not saying, like, what's the consumer, influence on these companies. We know it exists, though. I mean, AB InBev is like a living embodiment of the anti-woke consumer influence right now. But the long-term, I think, trajectory of ESG is, can you actually map the entire ecosystem of people and stakeholders that are associated with this company? The company might build a road, but it might dump, sewage next to the road. The company might. How do you measure the influence that each stakeholder has on the company and the company has on those stakeholders? Now, the ratings don't do that, and the data is partially there, but is not all the way there. And one of our stopping points was we didn't have all the data, and MSCI didn't want to. At the time, they were like, we're not. We have an ESG rating. What are we going to do? Put out another rating, and it'd be like who's going to know what to use? It's already confusing enough. And I was like, well, we'll make the other one less confusing. But I do think the point is, we don't know. We don't rank consumer influence over these people. But we know that that's a thing and that we need to pay attention to it. And I think the future is like a stakeholder model, like a broader model of humans.
Tanuja wanted to know, what do you think about putting CEOs on the board, especially powerful CEOs? Isn't the CEO of MSFT, I'm not sure who that is, the chairman of the board too?
Yeah, it's Microsoft. What do I think about having CEOs as the chair? On
the board.
I mean, having them on the board, they tend to be the chair. So usually what you're doing is you're consolidating power with the CEO. Sometimes, I don't have a strong feeling about it, in as much as I think it's stupid personally, right? Like, have you ever been in a situation in which you sat next to your boss while they talked about the job that you were doing, and you were sat on the committee that decided the job that you were doing was good or bad? Where you sat on that committee, you didn't get a vote, but you sat there and you make your case, and you're in the committee, you're in the room. You got 5 bosses, they're all sitting there, and you're with them, you're handshaking them on the way in. There aren't other situations where that happens. When you go to work, your boss is your boss, and they're deciding somewhere in a dark room how well you're doing, and usually you get to argue about your bonus or whatever. No, in this situation, they're putting the CEO in the room with their bosses so that they like them more. so that they're less likely to give them small bonuses. And you can see it in the data, right? You can see CEO pay data and CEO pay ratio data. It just skyrockets. So personally, I think it's stupid. But I get how investors would want that. The CEOs are usually the ones with the insider knowledge. If you think of a board, the board is like a defense and management is like offense. Management wants to go out and buy more companies. They want to like build new things. They want to increase market share. Management tends to be aggressive. Boards' jobs are often to be strategic and defensive. You've built up this company to this point. Doing that will get you into trouble. You're going to spend a tremendous amount of shareholder capital doing that with no, sight of return. That's not a great idea. Boards' jobs are to contain management often. When you see CEOs on the board, sometimes it's not a bad thing because you want some balance of aggression and, offense and defense. In my mind, I generally think it's stupid. I don't sit on our own board. Our own board is one person right now, but I'm not going to sit on our board, right? Like as we construct it over time, mostly because I think it's, I shouldn't be there. The board needs to decide board things. And my job is to tell them what I think and let them decide things. But it's really kind of a personal choice. In Microsoft's case, Satya, I believe, is the chair of Microsoft's board.
We're coming toward the end of the hour, and I promised I would keep it to 60 minutes because you've got a busy schedule. Is there anything that we can do? The ones that will be watching this live and most watching the replay, we'll send you, if you want, a copy of this so you can use as you want. We'll start pushing it out to others, and everyone will get the link to the replay. Is there anything we can help you with, which we can help you?
I mean, right now, what we need is we need to break our stuff. One of the things that we never did at MSCI, and these companies generally don't do, is they sell you a product and they're selling you a product, right? We're selling a concept more than a product. We have a product, right? But we're selling you an idea that humans make decisions at companies, and how can we measure those humans. But we're going to be wrong. We've done a lot. We've done 2 years of thinking. We put all our own money into it. We have no investors, right? It's just us. So what we need is we need philosophical challenges. We need thoughtful critiques of, have you considered this? We want to know uses, because we don't even understand all the uses. We're very much in this phase where we've thought through how to measure a thing that we don't know that anybody wants or how they're going to use quite yet. We've seen some, but we want to test the limits of it. We want to be told we're wrong. So more than anything, go sign up, get the S&P 500 for free. Try using it. Reach out to us. Tell us how good or bad it is. Tell us what you wish you could see. Tell us, because for us, if we don't get it right, we don't disrupt the market, right? Like if we don't get it right, we don't start seeing change. So our goal right now is to get it right.
That's fantastic. I really appreciate the conversation, but also all of the work that you do. So let me just take a quick group selfie to prove that we're actually working today and not hanging out at the beach. I want to thank Matt for all of the radical truth honesty. Watch his podcasts on FreeFloat. It's really very, very good. And I want to thank our entire production crew for making this webinar possible. Sam, our producer, Crypto Genius, and Ramen Critic. Ricky, my absolute better half with no filter. Xi Jinping, our head of transparency and integrity. Vladimir Putin, our head of conflict resolution. Marjorie Taylor Greene, our Nobel Prize winner for stupidity. Elon Musk, our humility coach. And Donald Trump, our prison inmate fashion advisor. So thank you all very, very much for joining. If you want to stick around, we'll do a quick virtual mixer. I'll send everyone the link to the replay and also a copy of this group selfie. So Matt, fantastic the work that you're doing, and also your willingness to be vulnerable and say, hey, what are we getting wrong over here? So I think that's great. Let's jump into the virtual mixer if you
Well,
want
let
to.
me say before we jump into the virtual, I won't be able to join the virtual mixer
No,
because
it's okay.
I have to go get the children. But that said, please reach out to me. I'm Matt at freefloat.llc, LinkedIn, wherever. Ask. I didn't get to all the questions. Ask us questions, and really, it'd be great to have like good conversations with smart people. That's what we
Sure.
look for.
We'll share everyone your LinkedIn and your email in case they missed it. Thank
Awesome.
you, Matt. You stay
Thanks so
well.
much, Robert. All right, take
Bye
care.
bye.